Happy to be here and excited for the chance to work with Cornerstone. They're a great group. We've been, talking about investing together, partnering together over the years, and excited to be doing that. I'll do a quick introduction. I grew up in Boston, and I do like the Red Sox quite a bit. My brother has season tickets, and they're over behind third base. Not bad. And he sells them at face value for friends and family and all that. So you can definitely ask me if he's got any left. I don't know if he has any left. They're having a good year. Grew up there, moved to Seattle after business school in Boston. Went to Seattle for a couple years working for Microsoft. Good experience. Moved down to San Diego in 2005 and started working with Gary Sabin at Excel Trust. Did that for a while. Until we co-founded Sundance Bay, myself along with my brother and a couple partners. And I'll tell you a little bit about the company later. I thought I'd start though with a little bit of a overview from my perspective of commercial real estate. Now, I'm going to offer opinions and fact. And I'll offer fact and sort of draw some conclusions based on those facts that I see. They may differ from your own, and that's fine. But this is just from my perspective, and I think, given the backdrop of what's happening in commercial real estate, I would ask the question: how and where should we invest? So I'll do that, and then maybe I'll jump into where I invest a little bit, multifamily, and a couple other areas, and then I'll give you a little overview of the firm. As well as our investment strategy and maybe some returns, things like that, and just an outline of things that we're doing. And then take any questions that you guys have. Happy to have a discussion. If anyone has any burning questions along the way, please stop me as well. Happy to just make this more of a discussion than anything. So let's test out this little thing that he gave me. Yeah, that's kind of cool. Signs of bubble trouble. So we all know how much of a bubble was happening in 2007. That bubble burst, set the stage for one of the greatest and deepest recessions in our history. So we have to ask ourselves: Are we headed the same direction again? I would say that asset prices are very inflated. You're seeing asset prices higher in many categories. I would say most sectors than they were pre-recession levels. Interest rates are clearly on the rise. That has an impact of potentially raising cap rates. There's a big debate over that. There's two trains of thought. One is that interest rates, that cap rates are correlated with interest rates, and they will go up as interest rates go up. The other train of thought is that they're not correlated, and as interest rates go up, there's so much demand for real estate, not only in the U.S. but also from foreign countries, especially for U.S. real estate, that cap rates will remain relatively stable. So two trains of thought there, but clearly interest rates are on the rise. From my perspective, it's different than the recession before, and that is on the debt side, we're still seeing that creditors are applying pretty conservative leverage. Most operators are taking pretty conservative leverage. The underwriting on the debt side tends to be fairly strict. As we go and try to secure debt, they do a really good job of underwriting our deals, underwriting our team, and we see creditors doing that consistently across real estate. On the equity side, as I look at my peers, I feel that they're being responsible in their underwriting as well. We tend to be really conservative. We think that sometimes we're a lot more conservative than our peers. Probably everybody thinks that about each other, but we're not seeing such aggressive assumptions. Most of the assumptions we're seeing are plausible. There's some distinctions there that I'll mention later, but one of the exceptions might be 1031 investors tend to be a little more aggressive. So those are some of the macro trends that we're seeing in commercial real estate. I thought I'd talk just quickly about the different property types, again, from my perspective. And I want to preface this by saying these are generalities. In each of these product types, you can find a good niche strategy to really have a successful investment. So it's not meant to say don't ever do office, retail, etc. But just I wanted to give you some thoughts about the space from a macro perspective, from a general perspective. From what I see, office is a tough space to invest. Again, my opinion. First of all, the cash flows that you get tend to be given away to leasing commissions and tenant improvements, and that's pretty consistent in the business, and that hasn't changed a lot. But another thing that I think is a little troubling is how much virtual officing and technology is sort of limiting the demand for space, and we don't really see that going away long term. So long term, I don't love the supply and demand outlook for office. And again, happy to take questions. Retail. We're seeing continued downsizing of retailers based on e-commerce. And that's frankly one of the reasons that I left Excel Trust several years ago and started Sundance Bay. Is I was in the shopping center space and I didn't love the outlook long term. And obviously we timed that well. We sold to Blackstone, that was great. But I think that's going to be a trend that will continue over the next 10 to 20 years. In my view, there's just too much retail space out there and not enough demand, and I think the demand will continue to shrink. Industrial, I think, is a very positive space. As retail shrinks, industrial seems to be the beneficiary. There's more demand for warehousing, distribution because of activities like e-commerce. We don't have a lot of experience in it, so I don't personally invest in it, but I think it's a positive space. Lodging. My view of lodging is that it's great when the economy is great, and when the economy is not great and there's a little correction, it corrects very quickly. Rents are set literally every day, and so you've got to have a pretty good appetite for risk going for lodging properties. So hospitality, hotels, self-storage, I think, is a terrific model. Kelly Burt in here, I know, has made a lot of money with self-storage, and I consider him one of my mentors, and he cautioned me never to get into self-storage unless I was prepared to compete with Extra Space and Public Storage, and their ability to operate, their ability to market is so hard to replicate that it really is a tough business to succeed in. It's more of an operating business than a real estate business at times. I don't know, I'd be curious to get Kelly's thoughts on this, but there are some potential headwinds as you think about the vehicle industry shifting towards electronic and or electric vehicles and self-driving. That'll open up more space in our garages and garages throughout the U.S. So some potential headwinds. I'd be curious to get some people's thoughts on that. But that's how I see some of the main property types in commercial real estate. That's how I see, just from a macro perspective, what's happening to commercial real estate. And so, again, I would ask, where and how do you invest? So from my point of view, it's really, given these trends, it makes a lot of sense to carve out a niche strategy. I didn't talk about multifamily. That's where we're investing. And we kind of see multifamily in much the same light. Asset prices are inflated, very inflated. There's rent pressure now. Rents are starting to moderate. There's been a lot of rent growth over the last 5-6 years, and that's starting to come down a little bit and projected to maybe come down a little more. There's potential oversupply, so developers have gotten very aggressive. I would just mention that those are in specific markets. They tend to be Class A properties, coastal gateway markets, Tier 1 markets. So it's not pervasive across the country. If you know where to look, it's not everywhere, but it is definitely a concern that affects fundamentals. And so I would actually argue for core properties in primary markets, there's potentially more downside risk than there is upside potential right now if you were to invest in multifamily, just in the generic way. So I, again, would argue for a niche strategy. What we're seeing, though, are some really positive trends as well on the demand side. It really, again, given the backdrop of Class A primary markets, we're staying away from those types of properties. We really love how much renter demand there is in the affordable space, we call it the workforce space. So people that are making 40 to 70K median household income. It's just, there's just not a lot of supply in that space. We see that millennials now have replaced baby boomers as the largest cohort in the U.S. population. A lot of them are delaying marriage and children, and almost have a preference for renting as opposed to owning homes. So there's some interesting, trends there. Speaking about supply and demand, what we're seeing is obviously all the news. Every time someone builds a new property, you kind of take a step back and you say, what kind of property do you need to deliver? Well, they typically need to deliver Class A luxury. And why is that? Because it's very expensive to entitle. The land is very expensive. They're focusing on some of those key markets where competition is fierce. And so they're going in with such a high cost basis that they're having to then turn around and offer rents that are also very high. As a result, the space that I'm in, Class B and C, tends to shrink over time because there's a certain amount of obsolescence year over year. Properties are getting older and older, and a lot of them sort of go offline, and then there's not a lot of new supply. But by the same token, there's increasing demand year over year. So we kind of like those fundamentals. And that's the space we focus on. I guess just a quick chart. 80% of renter households earn $75K or less. So there's really, it's really a big universe of people that we're focused on. So given what we're studying, our strategy is pretty differentiated. We're really focused on value add. We're focused on secondary, and some might even say tertiary markets. We've done investments in markets like Kansas City, Louisville, Phoenix, Atlanta, Indianapolis. So markets where we don't see as much competition and as much sophisticated competition. It's a little bit below the radar of the large institutions, the large REITs, the large private equity funds, the Blackstones of the world. We're really not competing against them, and we like that quite a bit. We tend to be buying smaller assets. If I were to kind of characterize what our assets are like, they're smaller, they're hairier, they're older, and they don't look pretty on a brochure. So, I mean, if you want a nice, pretty picture, you're probably not going to make very good money. If you're looking to make some good cash flow and some good yield, that's what we're focused on. And the properties tend to be a little bit ugly, and I'll take you through that a little bit. But we have a strategy to improve those. We have a vertically integrated team. We think that's important as well because we do everything from sourcing the deal to managing the deal, managing the renovations, the construction, selling the deal. We do everything. A lot of real estate investors, they just get involved in sort of picking sponsors. So they get as much money as they can from investors, and they say, here's our strategy, and they sell it, and they get money, and then they go out and they pick, honestly, groups like me, sponsors and operators, and then they give us money, and we give them the same returns that we would give you, but then they run it through their promote structure as well, and sort of that reduces the amount that actually goes back to you guys. So, I would call us sort of an opportunity to invest direct with an operator or a sponsor rather than what most people do, and that is kind of picking sponsors like us. And just kind of if you look at the continuum of risk, core is meant to be the lowest credit risk. I would argue, as I did earlier, that's potentially in question right now. You move up the scale. We're focused more on the value add opportunistic space where we're trying to achieve higher returns, and we're taking a little bit bigger risk on the construction side. That's our strategy. How we do it is we spend loads and loads of dollars and hours gathering data from sources like these. And we look at things that we believe really drive renter demand and drive value creation. And just give you a few examples of those types of criteria. We're looking at the cost per door of buying an apartment. We're looking at how much investment is happening in an economy based on healthcare, education, technology. Those three areas, in our view, really drive the vibrancy of an economy, provide good, diverse economic growth. So we like to see that kind of activity. We like to see hospitals and universities nearby where we invest. We're looking at, again, historical and projected performance. We're looking at job growth. One of the things we love to do is we look at the amount of supply coming online. So how many units are being developed, how many units are being projected and planned to be developed, versus the number of jobs that we project in that area. And if we think the ratio is healthy, we invest, and if we don't, we don't. So then we take all this data, we synthesize it, we analyze it, and then we just rank sort. We rank sort markets based on what we think are attractive value creation metrics, and we pick markets to invest in and properties to invest in based on that. So that's maybe just a quick backdrop of what I see as the commercial real estate space, the multifamily space, how we're responding to it based on the numbers and the data that we're seeing. Any questions to this point before I kind of give you a little overview of the company and how we do things? You guys are an incredibly quiet crowd so far. Chuck, good to see you again.
What's the difference between Class B and C?
You know, it's a little bit of a subjective grading system. It tends to be age and you know the demographics of the area and the quality of retailers, and so you know, Class C might be you know 35 to 42 median household income. Retailers like Payday Loans and you know Chick-fil-A and a few others, and Class B might be moving up into sort of the 40 to 50 median household income. It might be more like 80s to 2000 as opposed to 60s and 70s, and it also is sort of reflective of the condition of the property. We just look at what we like to do, and I appreciate the question because it really highlights what we like to do. We like to find a class sort of C plus, B minus property. That's our sweet spot, because what we like to see is that the bones of the property are actually in good shape. The structure is pretty good. And that we could go in and we could not focus so much time and energy and money on fixing deferred maintenance, roofs, parking structures, HVAC. You just don't get any rent lift from that. We may have to address it, but if we have to address most of our money on that, it's not an attractive property. However, if we go in and it's sort of a Class C plus, B minus, and it's in decent shape, but the owner hasn't really renovated interior units, hasn't renovated the clubhouse in a long time, and it's right for us to go in and spend money on those things that we think lift rent, which is the facade, the amenities, the clubhouse, the floor and cabinets inside the interior units. Those types of things really lift rent, and so that's what we like to focus on. I appreciate the question. Any other questions before we dive in? I'll give you some examples of what we do. So just quickly, our firm, it's multifamily, but we also have two other business units. We have the debt lending business as well as net lease investments, and I'll give you a quick highlight of those in a minute. Our team is myself and actually 6 other partners. These are all our partners. All steeped in real estate, and a lot of us went to BYU. You can tell that. Some of us went to MIT and HBS and different places, and we've got a couple of us that were at Columbia that did their masters in real estate there. And several other key team members. I guess one person that you may recognize, and I've got a better picture of him now. This one, Kelly, is really, I did the best I could on the internet. But this is our board of advisors. We really appreciate their wisdom and experience. They've got great experience, and we're learning a lot from them, and they're really steering our company, I think, in a very good direction. So that's just a little bit about our team. Let me show you what I love about this space. This is pretty typical of what we invest in. I'll call that sort of a C plus. In a B area, maybe a B plus area. This is in Lenexa, Kansas. It was called Oak Park Village, right next to a mall called the Oak Park Mall. and other shopping centers. And there's 40 corporate headquarters nearby. It's really a good job growth area, a lot of good, sort of workforce and I'll call it gray collar jobs in the area. And you look at sort of the pinkish brick, the mansard roofs that are coming down, and the yellow, or I guess the sort of pink roofs, maybe the yellow and pink brick. We just transform that into something that looks really modern and fresh. Most of our residents, when they see this, they actually think it's really new, if not brand new. And so with about $1.5 million, we were able to rip off the mansard roofs, put on corrugated metal, paint the brick a nice charcoal gray, and then renovate the interiors as well. But that's pretty typical of what we do.
Windows and the doors too?
I'm sorry?
Do you replace the windows and the doors too?
It depends. We like to replace the doors because you sort of get a nice pop on those, especially if they're in good shape, we'll paint them, and a lot of times we'll do sort of neutral colors on that, and we might give the door like a good red or a yellow and just sort of make it pop. The windows, if they're in need of replacement, we absolutely do, because it's just something that tenants notice. We also tend to save a lot of energy when we put in new windows, and that's a good cost savings if we're operating the property.
Do you lose the existing renters?
It's a very good question, and this is where real estate is kind of an art and a science, because we do a lot of analysis going into buying a property like this. We look at the competitive properties, religiously. We're looking at, do they have legacy units? Do they have renovated units? On the renovated units, how much rent lift are they getting? How much did they spend, do we think, to get there? What are the fit and finishes of those renovated units, and could we match those? Could we deliver a superior product? Spend a lot of time doing that. And then we make an investment thesis based on this analysis. And many times the investment thesis is, we think we're going to be able to keep 60% of our current renters. The other 40%, they probably can't afford the new rent. They probably don't want to be there. We may force them out because of if they've got a criminal record or other things that we don't like. We may non-renew them based on higher tenant qualifications. But yeah, it really depends on the makeup of the tenancy that's there. In some cases, we've brought the tenancy down to like 30% occupied, and that's gutsy. I want to emphasize that's really gutsy in our space, but it's something we believe in, because a lot of times you can't bring in a new tenant that you want and really achieve that rent lift that you're looking to achieve unless you sort of change the demographic profile of who's there. If you're scared to be there and live there, that's going to pose a problem for attracting a higher quality tenant. Hopefully that's clear. We've gone to some properties where UPS drivers, FedEx drivers won't deliver, to those communities, and it's cause for concern. We look at crime and things, and we look at crime in the area, and we say, is that something we can fix, or is that sort of indicative of the area at large? If it's indicative of the area at large, we're not going to touch it. If it's something we think we can fix at the property level with really good management, adding a complete renovation, revamping management, adding lighting, and maybe a gated fence, a number of things like that, we may address it. So, good question, Chuck. Just quickly, we've done about 5,000 apartment units. This is on the multifamily side, the business that I work mostly on. We've done about 5,000 units. We've raised $125 million of equity, increased the NOI on average 107%, and we've delivered a net IRR to our investors of 28%. And that's, from what I can tell based on talking to peers, I haven't found, well, I'm sure there are people doing better, but I would say it's well above average. And you look astute enough to understand that. And maybe I'd ask for Cornerstone to give me some other examples if they have some. Which is a average realized net equity multiple of 2.1%. So essentially, we take our investor capital equity, and then in 3.3 years, we've doubled that in the properties we've done. So we've done pretty well. Lots of people have done well in the last 5, 6, 7 years. It's been a good market. I don't really honestly expect that we'll do that well in the next 5 years. I really don't. I just given everything that we've talked about. But I do think we'll continue to do above average. And we're sort of targeting, 15 to 18% net returns, IRRs. And we do like to beat our expectations. I'll leave it at that. But that's just a little bit. Here are some of I mentioned some of the communities we've invested in. The black or blue highlighted ones are properties we've sold. The other ones are properties we own or have under contract. And so you'll see a theme a little bit. We like the Midwest. We like the Southeast and the Southwest. We do have properties that we continue to find in those areas. It's funny, a lot of the institutional investors that I've worked with over the years, they're not even really aware that there are states in the middle of the country. It's just sort of, the Northeast and the West Coast, and everything else is sort of a flyover state. We love that institutional bias. We play off that. Just give you, I guess, a quick look at some of our results, but I'll just note that we've increased rents about 26% across our portfolio, which is just about 100% of what we projected in our pro forma model. Most of what I'm seeing, as I mentioned earlier, peers like ours, our peers, their projections tend to be plausible, but they tend to be a lot more aggressive on the rent growth side. And again, I would say that we're sort of moderating rent growth, looking at in the next 5 to 10 years that those rents aren't going to grow as quickly as they grew the last 5 or 10 years. The way that they're still making deals work and deals pencil is that they're still projecting pretty high rent growth. And we want to be pretty conservative about how we do that. These are some of the deals that we've sold, just to sort of make up that 28% IRR, as I mentioned. I'm flying through this a little bit, and if anyone wants to see this, I can just send it to you. So I'll fly through it a little bit longer. I guess just a quick case study. Here's a property we bought in Kansas City, and it's right next to a large healthcare IT company called Cerner. Anyone actually heard of Cerner in this room? No. Cerner's one of the largest healthcare IT companies in the world, headquartered in Kansas City. They decided to move their campus to an area called the Old Bannister Mall area. The mall was a Class B mall, and it needed to be demolished. They demolished it. There was a lot of vacancy, and they're putting in 16 to 18,000 employees in that area. So they're completely revitalizing that area. Once we saw that they went under contract, we bought a property a couple miles from there and renovated it, redid it, started to attract some Cerner employees as they moved in their first phases, and obviously did well with that. You can kind of see, this is pretty standard. If you look at the clubhouse before, it sort of got that, I'll call it sort of 80s, living room feel, and just hasn't been updated in 30 years. And we just go in and I guess I'll kind of characterize it as like a IKEA concept where it's modern and fresh. It's not that expensive, and it's pretty easy for us to do. We kind of have a color palette. We have a brand, and we just replicate it over and over again. We know what it costs. We do that on the interiors as well, and so as we look, we're still finding deals. Deals are really, really hard to find, and so as you think about investing in real estate, I would just caution you to think about those things that we talked about at the beginning, and to focus on areas where, if you know the sort of macro trends, focus on those types of niche opportunities that sort of play against those, because we're focused on secondary and tertiary markets, Class B and C properties, with good fundamentals. We're still finding things that pencil. So we're projecting 20 to 22% IRRs, 19 to 21%, 18 to 20%. That's hard. It's hard to find that. We look at thousands of deals every year, and we've got a team that analyzes them, and we run it through our models. And if we finally find something that hits, then you actually have to win the deal, and it's very challenging to get to this. And so this is just an example of our pipeline. But you can kind of see, I mean, the properties are, they can be pretty tired. This one actually, this Shadow Creek in Kansas, is actually right next to the Cerner. It's even closer to that Cerner campus I told you about. We decided we're just going to do it again and buy another property there. This one's kind of built. This one's built in the 70s, maybe even a little bit older. We're going to do a lot more renovations on it. This one, well, I won't go through it in too much detail, but yeah, we're looking to invest, 1,000 to 2,000 units a year, 5 or 6 properties a year. We don't have a gun to our head to invest more than that, which I think is important. And we are looking to launch a fund as well, maybe in the 4th quarter of this year. Everything we're doing right now, we just take in investors on a deal-by-deal basis. If you like the deal, we'll see if we have room. If we have room, you can come in. We set a minimum of $250K. I'm sure for Cornerstone, I'm sure they could work out, better arrangements for you guys and for other of their clients. And then, so that's how we're doing it, sort of deal by deal. Going forward, we will look to do it in a fund. Either way, I would recommend that if you invest in real estate, don't just invest in one deal. Invest in multiple deals if you can. So, put in a smaller amount in one of our deals and then sort of continue to do that over time, or invest in our fund or another fund, and that allows you to get some diversification so that all of your capital isn't tied up in one deal. And something may go wrong with one particular deal, but most of our portfolio hopefully will be in better shape. I love the multifamily space because there is actually good upside potential, as I think I've demonstrated, but there's actually really good downside protection as well. So unlike the other property types, with a couple of exceptions, I do like self-storage and industrial, but unlike some of the other property types, if things go wrong, there's a recession, a correction of some kind, from our perspective, people still need to live in apartment buildings, and we're not going to do as well as we projected. We probably won't do a 18% plus IRR, but we'll do pretty well. We'll manage for cash flow, we'll hold the asset. Our leverage it tends to be 65 to 70% max, and so we can also borrow from Fannie and Freddie and HUD, government agencies, which is a huge advantage for the multifamily space. And so, given all those things, we think we're in actually pretty good shape on the downside. So that's a little bit about sort of the market and us. Let me just check the time.
Matt,
I think we're right on time.
can you talk about equity versus debt?
Yeah.
You got both investments.
Yeah, thank you. I'll touch on the debt for just a second, because I don't want to cut that short. But equity side, higher returns. It's going to be tied up a little bit longer, 3 to 5 to 7 years. That kind of horizon depends on the asset.
Cash flow on the equity side?
Yeah, there's not a lot of cash flow in those first few years, to be candid, because a lot of it's getting put back into renovations. It's heavy value add, and so you're really looking to generate kind of outsized returns on your exit. But after year 3, we really do start to distribute cash as we can. On the debt side, we have a debt fund that I'll touch on quickly. I didn't want to spend too much time, but I think it's worth doing just a quick overview. It's about $90 million of equity right now, and a couple of my partners run that, Mike Nixon and Stan Ricks. I really love it. I put a lot of my money in it, and I've been investing in this and another debt fund for several years, and it's essentially just providing construction loans to real estate developers. And for that, you're getting a really good current return. You're getting 10 to 12%. On average, over the last 6 years, with our audited track record, I think we've done 11.7, 11.8% on average. And
net to the investor?
Net to the investor after our fee, and we take a 2 and 20 structure on that. And so, that's a pretty good return, given that 96% of our loans are collateralized by the property. So we're taking a first position. Yeah?
Actually, looking at specifically going after lending for builders, looking at what potentially
We got pretty scarred in, you know, 07, 08, and 09, and so there's a few things that I like about this strategy. Number one is the fact that a lot of what they're doing is the commercial space. They're not doing a lot of land loans. If they're doing any, it's on the single family side, and they're doing that with a very limited ratio. And so there's not a lot of speculative development. It's based on, you know, especially commercial loans, or commercial properties. So the land is fully entitled and ready to go, and then the lease is signed with a commercial tenant. And we like to see that risk is taken out before we actually provide a loan to a developer. And then we're also not applying leverage. Most debt funds have leverage, and so they sort of juice up their returns to get to that 11. You know, they might get to a 9 to 12 net return to the investor. We're getting a really good return without using any leverage, and that helps us on the downside as well. And lastly, as you know, we're all kind of real estate operators, and so if we do run into a situation where we start to get some properties back and there's a correction, we actually don't mind that. You know, we think that we'll be able to handle those types of properties and operate them in-house, and so that gives us some good protection against that as well. Any other questions on the debt fund?
Yeah, man, something like that. Worst comes to worst, you do take the property back. It's really it's just the holding. You hold until the economy comes back, so you may not be earning that money along the way, but at some point you're going to get that money back and it's going to be a profit.
That's our approach, and that's why when we underwrite a property, you know, we look at it as though, would we be comfortable owning this property, and most of the loans that you'll see. We've done a few hundred loans, and I guess 197 loans. Really, among those, the types of properties that we're investing in, you've got a good chunk of multifamily, you've got commercial, single-tenant, triple-net properties, and we'd be pretty happy owning a lot of those assets. So that's just a quick note on the debt fund, which is another place that we like to invest. I guess just quickly, you can see kind of the track record here. Oh, sorry, this is, I went a little too quickly. Way too quickly. Sorry. Let me get back down. My back button was actually not going back. So, one other area where we like to invest, I mentioned shopping centers. I really don't love the big box. I really don't love the big box shopping center space. I do think there's a little niche opportunity in the single tenant triple net space, and so we have a group that is also doing some investments in that space, single tenant triple net. Again, they want to see that the land is entitled and that the lease is in place, taking that risk out, and then they partner with developers, and they provide, instead of the debt, they provide the equity. And this thing's just like, that's all right. We're gonna let it play. Yeah, look at that. Magically, it went right there. So essentially what we like to do is we provide the equity to the developer, and where the lease is in place, the land is entitled, and then we split the upside. So that's one of our businesses, capitalizing on the retail space, on a niche strategy there. Those are our three businesses. Any questions at all? Yeah.
Matt, I understand on the equity side, you're looking at B and C buildings that other folks might not spotlight. But tell me, on your due diligence, are you looking at numbers or metrics that other people would ignore, that would greenlight a deal for you that somebody else wouldn't see?
Honestly, I doubt it. I think we tend to look at the same type of things. We spend a lot of time on demographics. We spend a lot of time on a lease profile, the rent roll. We spend a ton of time on jobs forecasted, new supply. I think those are pretty consistent. I'll just tell you that everybody looks at similar data and draws different conclusions, and you tend to see how those worked out based on results. And I would stack up our results against any of the other groups. So I really like where our analysis and investment thesis has led us. you know, just based on our view of what can go wrong and what can go right, I really like where we're positioned for the future as well. So I think it's just a judgment call. There are a lot of good groups out there doing good data analysis who are coming to different conclusions about where to invest. And so I would encourage folks to look at track records. I think that's really, really key. And also look at the team. Can you trust the team? A lot of times there's ways for sponsors like us to sort of game the system, and that's just not our style. And you kind of have to determine whether or not you trust an operator and a sponsor. Are they you know, honest? Do they have good integrity? I think that's important as well. And you know, just give you an example. Most of the other operators that I talk to in my space, when they go get money from a large investor, the large investor requires them to put in some good skin in the game, some good money in each of the deals. And I ask, you know, my other competitors, like, well, how are you doing so much money in every deal? Oh, we don't actually invest equity. We just take our fee, and whatever that fee equals, we roll it in as equity in the deal. And I'm like, well, that's not exactly doing what your investor's looking for you to do. We take money from our bank accounts and we put it in the deal. We don't take our fees and roll it in. There are lots of examples like that, but it just goes back to what type of team is really running this. Can you trust them? Do they have a good track record? So, yeah. Other questions? Okay. One last question back here.
You mentioned in investing in multifamily,
Mm-hmm.
a rate of return between, what was it, 15 and 20?
Yeah, looking forward, we're sort of 15 to 18% net to you guys.
Okay. And so, over what time frame are we talking about?
We tend to do we underwrite to a 5-year hold. And what that means is, you know, you put capital in, after 5 years, you may have gotten a good amount back from distributions, and then as we turn around and sell the property, you know, you exit, we give you the capital back. There might be a refinance as well. You get some capital back that way. But at the end of the day, the amount of capital you get back equals 15 to 18%. And that's pretty healthy.
But generally no distributions for the first 3 years of those 5 years.
Generally not. Now, there are some exceptions to that. There's some properties we're buying right now where we think we're going to keep a property 85, 90% occupied through the renovation and do a little bit of a slower renovation, and we'll probably distribute cash flow more consistently. So it depends, but for the most part, given value add, you shouldn't expect a lot of cash flow in the beginning. Obviously, that's different with the debt fund. You're getting cash flow each month, and again, I love it just because I just see it show up in my bank account every month, and it's so it just depends what you're looking for. But those are two strategies that we like that are really complementary. So yeah.
Any questions? That will stick around, sure, afterwards.
Yeah. Thanks, Chris.
Thank you, Matt. Appreciate it.